so let's talk about the liability stuff. And in the same way that assets are classified by liquidity, liabilities are classified by liquidity. The only difference is assets are when the company will expect to receive cash, or when the asset will be converted into cash, whereas liabilities are when is the company going to use or need to use cash to settle its obligation. So highly liquid liabilities are bad from the company's perspective. Highly liquid assets are good, right? Assets convert to cash quickly. Liabilities mean, I have to use my cash in the short run. So when I think about what I would like to have in kind of current assets versus current liabilities, a lot of times people use as a rule of thumb that what they call the current ratio, which is current assets divided by current liabilities, that should be something like 2, because I need twice as much stuff coming into cash as I'm going to need to pay out, just for like a buffer and a security. Okay, not all companies have a current ratio of 2, but the idea is you certainly need to have it at the very least 1, because your liabilities are going to be coming due within a year, and you better have enough cash to settle those liabilities, otherwise you're going to face bankruptcy constraints. Okay, so what are these obligations? They're amounts that we may owe because we've received services or goods. What kind of account would that be? Accounts payable, right. Okay, taxes not paid yet. Either sales taxes that we've collected on behalf of the government if we sell products, or income taxes that we owe to the government. Any of those things could be included in our taxes payable. Interest on loans that we haven't paid. Usually this is accrued interest rather than usually when we actually owe the interest, we make the payment. So it's not interest that's overdue. It's interest that we've accrued because we've hit the end of the period. We recognize that we have benefited from the loan within this period, and therefore we should charge ourselves for the expense of interest in the same period, a matching idea. Okay, cash that we've received from customers in advance of providing goods or services. What do we call that? Unearned revenue, deferred revenue, advances from customers, any of those would be fine. And then the long-term liabilities are the obligations we expect to settle in more than a year, usually bonds payable, notes payable if they're greater than a year, pensions. We might have some obligations to our employees, and 10 years from now when they retire, that's when they're going to kick in, so that would be another long-term liability. And so if you just take a quick look at Apple, well, what do they have as their current liabilities? They're not a great example because they really don't have very much in their liability section. I mean, they're a great example of how to be a successful firm, but they're not a very good example of interesting liabilities. But in terms of their current liabilities, they have, the typical things. So what happens? Customers buy a product and it has a warranty. Well, what will happen is if within a year something goes wrong, or I don't know, maybe it's only 6 months or 3 months, your product is defective, then you come back and they have to replace or repair or fix it. Now, when should they recognize the expenses for the warranty? When you come in and ask for it to be fixed? When you purchase it. Why when you purchase it? That's the right answer, but why? Why would you? Why don't we just wait until the customer comes in and we'll figure out if they? Most things shouldn't have a problem. So why don't we just wait, see if you have a problem, and then charge the expense then? Yep. Okay. So the expense. Why are we incurring this expense? We're incurring this expense because we made the sale of the product. We want to match the revenues, or we want to match the expenses to the revenues that they're associated with. We wouldn't be offering warranties if we weren't selling the product. Like, we don't just say, hey, if you own an IBM, come in and, we'll fix that one too for free, like if something goes wrong with it. We only do it because we've sold our product, okay? Taxes, marketing and selling expenses. That would be an example of we have received marketing services, but we haven't paid for them yet. So how might that be the case? Well, perhaps we bought a Super Bowl spot, but we bought it in the contract only. We didn't actually pay for it. Well, as soon as that airs, we have an obligation, and we're going to have to pay for it, even if we haven't yet used the cash. And then accrued compensation, so wages that we haven't yet paid. We end the quarter, or we end the period, and we have to record all of the expenses up until this date. Okay? You know, there's one thing that I didn't talk about, and it was sort of a little strange. You wouldn't see it on every set of current liabilities. And so if you don't know what this thing is, you got to look it up. So there's this one weird thing called deferred margin on component sales. That's like not something we normally do or normally see. So then you just look at their notes and they say, oh, well, here's what happens. Because not only are we selling you the product, we're also selling you all the future upgrades. So, you know, you own an iPhone and then they come up with a software update, you get that update. So they actually are obliged to give you some stuff that costs them money. Okay, it's not like the software specifically costs them money because it doesn't come on a CD or anything, but the development of that software costs them money, and the obligation to you to satisfy that is an expense. Okay, so that's what they're telling you. These software, the rights that you have represent an obligation. They are not completely done. They are obliged to provide you with this additional support over the next 24 to 48 months. Okay? Warranty costs, they tell you exactly how they figure them out. They say, well, you know, we've got these warranties, and what we do is we estimate based on past experience what the cost per claim is going to be, and then we call that our accrued warranty cost. Okay, is this number for sure? Like, are we definitely going to end up shelling out 1,240, I guess, or 1,240,000 in warranty costs? No, right? This is our best guess. Could be that nobody's computers break, then we have no expense. Could be that twice as many as we expected break, and we have a much more significant expense. Which one? Yeah, the deferred margin is they don't know necessarily how much the cost of developing those upgrades are. They're anticipating some cost. Warranty is specifically based on either historical patterns or current projected patterns based on the type of products that they're selling. Okay, what about long-term stuff? So this is not. Don't look at this part. I don't know why the assets are in there, so ignore here. I'll cross them out to make it clearer. Okay, so I don't know why these are here. Go away. Okay, so what are some things that they might have in the long-term section? So we just saw the short-term section. Whoops, don't do that. The short-term section was that like small, specific section. And then here's deferred revenue. Okay, what is that? Remember, that's just advances from customers that they're not going to have to actually provide the goods or services within the current year. So usually if you get an advance from a customer, you have to settle that within a couple months. This could be that certain stores may want a guarantee that they'll get the product. So they'll give you a lot of money up front to say, hey, you know, for the next 5 years, we want you to sell us, you know, 50,000 iPhones or whatever. So until they actually satisfy that agreement, there might be deferred revenue that's longer term. Okay? Then we're talking. Then there's this line, and this is typically the case for all companies. You'll see this line after total liabilities called commitments and contingencies. Okay? And then you'll look across the row and you'll see nothing there, and you'll wonder, why have a line item if there's nothing there? And the answer is, most companies have some uncertain obligations, but because accounting says you need to be able to measure them with reasonable precision, they can't be measured. So the typical example would be if you have a lawsuit, okay? I'm sure there's constantly lawsuits against lots of different companies. So what would Apple be on the hook for? Well, they could be some sort of patent infringement. Now, you might argue that's usually the other way around, that they're suing somebody, but maybe technically they stole some idea from someone. Maybe they didn't steal an idea, but somebody's suing them anyway, okay? It could be the case that there's some potential, like, I don't know, negative rays that come out of your computer, and somebody has decided that this is causing them health damage and they're also suing you, or some sort of situation where you don't know the outcome yet. You're involved in litigation. It is contingent. The liability is contingent on the outcome. So if you're found guilty, then you will have an obligation. If you're not found guilty, you won't. So if it's contingent, then there are a couple of conditions for whether you would put a number here. And the answer would be, well, it has to be probable. Again, there's no definition of probable. So 70% likely, 80%, nobody really defines that particularly well. Probable and reasonably estimable. So if you say, well, our lawyers don't think it's very likely that we'll lose, and if we lose, we have no idea how much it's going to cost us, you won't have any number here, even if you're involved in lots and lots of different lawsuits. So when you look at companies that have had a history of lawsuits and failed lawsuits, they still won't have a number there because their argument would be, we don't know how much it's going to cost us. Okay, so that's a little bit, I don't want to say deceptive. I mean, the rules specifically say if you don't know how much it's going to cost you, you shouldn't record it. On the other hand, then it's a pretty safe thing to always say, we don't know how much it's going to cost us. So there are some liabilities that are probably, so when you look at their footnotes, you want to see, do I think there's any litigation that I need to be worried about? Okay. Then the last, and the reason Apple's not that interesting is there should be normally in this section like long-term bonds or notes, and it's just Apple has so much money that they didn't need to borrow any. So they don't have any long-term borrowing, but most companies would. And then you've got the equity section. That's usually fairly simple and fairly short. Okay, you've got common stock, which is just shares to residual owners. And this is recorded at cost, meaning when you first sold the shares to your investors, they gave you a certain amount of money. That's what you've recorded here. After that, the stock price changed, right? The market price of Apple doesn't stay constant from the first day they issued shares to now, right? Oh no. But why don't they reflect the fact that this number is changing all the time? So let's say I own some shares of Apple, and then the price of Apple goes up to, by $5 a share, and I decide I want to sell it. Does that mean I go and somehow give Apple $5 more? Do they give me $5 more? What happens when I sell my one share of Apple, which costs $200, and when I bought it, it cost $190, and now it's $200? What happens? Who gives me the $200? Some other person. So you and I exchange. You give me the money, I give you the shares. Apple is not part of that. So it doesn't really matter. They're trying to tell you how much did our owners contribute to the firm. Whatever happens in the marketplace, that's interaction between two unrelated parties. Okay? Apple only gets to record more contributions when they sell more shares. When do they sell more shares? Well, they could have secondary or subsequent offerings, but also they might have employees that get stock grants, and they say to their employees, okay, we'll give you 5 shares of stock in exchange for a certain amount of money. It may not be what the market is charging. It may be a lot less, okay? But nonetheless, this is how much we're getting as Apple in exchange for the shares that we're giving. This is just telling you what is contributed by the owners. Retained earnings, that's telling you here's how much we earned over the life of the firm. Yep. Mm-hmm. So for Apple, they have what's called no par value stock. Sometimes companies' stock has a par value. The par value doesn't have any meaning in terms of how much was contributed, okay? But it does. So let's say we have a company that has a par value of $1, okay? And they have shares outstanding. They have 10,000 shares outstanding. The only thing you have to know is that if this company were to initially sell those 10,000 shares for $20 a share, they just separate it into two. So they have $1 goes to the par value, and $19 goes to additional paid-in capital. Okay, so this company would have two lines where Apple only had one. One would be common stock, and it would just say $10,000. And the other would be additional paid-in capital, okay, for the other 19. Okay, the point here is the contributed capital is the same. It's $20 a share, and there are 10,000 shares. Okay, it's not that par value has no meaning at all. It's just not the value at which the company issues the stock. So is that the trick that they were? I mean, that's my guess of what the trick would have been. So we do need to record the full amount that we receive, the market value at the time of the original issue, not the par value. However, we're not recording the market value today. We're recording the market value when we sell the shares. Okay. Retained earnings. So retained earnings is how much the company has earned over its entire life and kept within the firm. So in any given year, we earn money, and then we decide what to do with it. We can either keep it, or we can give it back to the owners. If we keep it, we stick it in retained earnings. If we give it back, we don't. Okay, so retained earnings is whatever we had the previous year plus whatever we earned less whatever we decided to give back. So you can take a look. I think it'll be pretty obvious to you how successful Apple is, because their retained earnings was 37 here, and it's 62 now. Well, whether or not they gave any dividends, I don't think they give much in dividends, but nonetheless, their net income had to be enormous in order to get from 37 to 62 from one year to the next. Okay, and then had they given any dividends, it would be even higher. Okay, other things that you really don't need to worry about right now, but you'll see every now and again, would be other comprehensive income. Okay, and this is an account, and it's going to sound very judgmental, but this is where we put stuff that no one agrees on or that we don't know what to do with. Not that we don't know what to do with it in the sense that the rules say put it here, but the rules say put it here because there's a lot of disagreement about whether it should be regular income or not, and we've decided, well, it shouldn't be regular income, but on the other hand, we want to include some. So the primary example of this is on our asset side, we have marketable securities. And normally, for most assets, we don't record them at the market value because we're not planning on selling them. We're a going concern, and there isn't an easily estimable market value. But with marketable securities, all you have to do is open the Wall Street Journal and find out what the value of that thing is. And there is generally a greater intent to buy and sell the shares. Okay, portfolios are meant to be bought and sold. They're not operating assets. So what we want to do is we want to record gains and losses on those securities, but we haven't necessarily realized those gains or losses because we haven't sold the securities, but they have changed in value. So that change in value, if the asset goes up, we want the asset side to go up. We need some credit. Well, what we do is we stick it in this other comprehensive income. So it doesn't actually show up on your income statement because you haven't actually sold it, but your entire balance sheet does go up. Okay? Don't worry about this one too much. You'll deal with what belongs in there in Intermediate 2 a lot better. Yeah. No, if we are doing the suing, then we don't record anything. We don't record anything because we never include contingent assets. Now, contingent liabilities are another thing. You're always, conservatism says, well, if you know you're going to have a loss, you should recognize it as soon as possible. And so if you're the one being sued and there's some chance you're going to owe something, you should let investors know about that. Okay, so we don't let you know just if we might mention in our 10K, hey, we're engaged in some lawsuits. Sometimes we're doing the suing and sometimes we're being sued. But you wouldn't see a line item on the asset side for lawsuits that we initiate. Only the ones that we get stuck as the defendant in. Okay, and then we have the sum of total, we have basically these things give us our total shareholders' equity, and then we take all of our liabilities plus our current liabilities, and we're going to get our total liabilities and shareholders' equity. Yep. Okay. It could be treasury stock. It could be that they retired some stock. It could be, I'm reluctant, it probably is treasury stock, but they don't actually have it in treasury. And so what I think has probably happened to it is they're sort of holding it for compensation purposes, but they haven't yet given it out. So it might be, that's maybe where it is, or they're maybe there's some compensation pool which people can win an award from. But basically, issued just means this is how many we sold initially, and that's always a lot fewer than what's authorized. Authorized means here's how many we could conceivably sell without having to go and ask permission from our investors to issue more shares. So you give there's usually a lot of opportunity in the beginning, and then only when you sort of run out of shares do you have to go and ask all your investors, hey, can we sell some more shares? Okay. So now, when we talked about some of the intangibles, so when can Apple, so does Apple have an intangible that reflects their logo, their little apple, or that reflects how awesome people think their operating system is, or how efficient their company is? Like, do they have patents and brand name and those sorts of things on their balance sheet? Well, I didn't hear what you said. Yes or no? Oh, okay. I thought you were like, no, because I was going to. No is the right answer. So why doesn't Apple have a huge amount of, so we all agree Apple is somehow making a ton of money. It must be better than everyone else. Must be because people like Apple products. So why can't they recognize this brand name on their balance sheet? Yep. Okay, so we can't measure it because it doesn't have an exact value. And what does accounting say we're supposed to do when we develop intangibles internally? We expense all the costs. We don't get to record them. However, we can record intangibles when we have purchased them. So if we go and buy a patent from somebody else, which has already been proven to be a good thing, and the reason we're buying it is we actually think it will add to our portfolio, then we can record some intangibles. So Apple, if you just read their footnotes, they'll say, well, we had made some purchases and we bought stuff for $244 million, and we allocated it to intangible assets that we acquired, so maybe brand names, patents for some other company, plus the goodwill. So when we made a purchase of another entire company, this is what happened. Or during 2011, we acquired the patent portfolio of Nortel, and we paid $4.5 billion, okay? Well, that was the whole, that's what everybody paid. We only paid 2.6, and we called that acquired intangible assets, and we're going to amortize them over 7 years. Okay, so when it's true Apple has some intangible assets, they're just not the ones they created internally, they're the ones that they bought. Okay, so clickers, take out your clickers. Since I made these clicker questions for exactly this reason, except of course I didn't. Okay, so let's take a look at liabilities. You tell me, I'll give you a liability, you tell me whether it is a current liability, A, a long-term liability, B, or neither one of them. Okay, so what should I do with taxes payable? Whoop. Okay. Everyone thinks taxes payable is current. Why is taxes payable current? Generally, you know, when do you have to pay taxes? At least once a year, generally quarterly, right? So if this is income taxes payable, you're going to have to pay with some regularity. What about sales taxes payable? Well, that too, the government, you are collecting on behalf of the government, and you owe, you know, when you go to a store like Target, some of the revenue or some of the cash they're collecting or credit card bill they're collecting is coming from you for their sales. But then the portion that's income taxes, they're just basically serving as they have your cash, but they're holding it. They don't have any revenue associated with that. They have just an obligation to pay that to the government. Okay. So how about bonds payable if the bond is payable in 5 years? Where does that belong? All right, nobody's concerned. All right, now what if the bond is payable in 5 installments each year? So it's payable, let's say it's a $50,000 bond and I have to pay $10,000 each year for the next 5 years. How would I record that? Okay, so how much? The $10,000 would be current, and the remaining $40,000 would be long-term. Then a year passes, well, then you shift another 10 up into the current, and you keep the rest in long-term. Okay, so there's nothing wrong with having bonds payable in both sections. You have to make sure everybody completely understands which portion of bonds are current, because if you stick everything in long-term, people might be much more comfortable with your ability to pay your debts, when in fact, if it's coming due this year, you need to actually, you know, do it immediately. I see you people who are like screwing up my little data here. Don't do that. Okay. Of course I can't. Interest payable, is that long-term, current, or current A, long-term, or neither? All right. So most people agree that it's current. Why? When might it not be current? Yeah. Okay, so in some cases, like a bond which has zero stated interest, so those are sometimes called zero coupon bonds. you don't actually make an interest payment until you pay off the entire bond. And you're not making an interest payment per se, you borrow maybe $50,000 and you pay back $75,000. Okay, so embedded in the payback is the interest. So even though you're going to accrue interest every period, you may not actually pay it until the end. However, what's much more typical would be a bond comes with a stated interest rate. You make semi-annual or annual interest payments, and they're current. Okay, so current is definitely the more likely answer. Long-term is possible, though. Okay, how about accounts payable? What do we do with that? All right, great. Why would you, who wants to put accounts payable in long term? What would be a situation where you can imagine that being the case? Yeah. Okay, so if there's some like incredibly nice supplier who says, hey, we want you to do business with us. We're going to give you free stuff, no payments for a whole year. Great, okay? That doesn't mean, you're getting something for nothing. Obviously, presumably they're going to charge you for it in the long run, but it's possible that you don't have to make a payment before a year. Typically, accounts payable belongs in the current liability section. All right, how about a possible lawsuit? All right, so now we have a little bit of debate. Now, possible lawsuit, you haven't even, or possible lawsuit loss. So you haven't been judged that you actually owe the obligation yet, and it's only possible. So in order to record a loss for a lawsuit, it has to not only be measurable, but it has to be probable. So possible is less than probable, right? I mean, there's no numerical definition, but remember I had very, very, and just sort of like, well, so I mean, probable is more likely than possible. So if it's only possible, you wouldn't include it. Yeah. If it was probable, then it might be a long-term liability, but it still might not have a number associated with it if it wasn't measurable. No, conservatism says you should tell everybody that you have these obligations, but the flip side of it is, but we don't want to just make stuff up. We don't want the numbers to be so noisy. So if we don't, the problem with lawsuits in the U.S. is, we have such a litigious society, and we have such random judgments that it's very hard to predict. If you have a jury awarding you for, like a slip and fall, one person could, say, oh, that person should get $5 million, and somebody else would say, what, $20 bucks? That's about all they deserve. The cab ride over. So it's just really hard to predict. And if it could be anywhere in that range, would you be doing more harm than good by telling people that it was, that you would be harming the company if they had to record a loss of $5 million when in fact they were only going to pay 20 bucks. Okay, so that's the concern there. All right, how about the current portion? So normally a mortgage would be like a 10, 20-year payment. What about the current portion that's due this year of the mortgage? Does that get lumped with the long-term liability, or does that get split out into the current liability, or do you do nothing with that? All right, good. Everyone thinks the current portion belongs in the current section, and you would actually write current portion of long-term debt or long-term obligation. Okay, bond due in 8 months, payable from a bond sinking fund. This one's kind of a trick. I mean, I'm telling you now, so you can change your answers too. Okay, so the problem with this is, I'm glad. Okay, everyone's like, oh, I don't know what it is. Okay, it is still a liability. Okay, but because you have an offsetting asset that's held as a long-term asset to pay for it, like so, when it means, if you say it's going to be paid out of a bond sinking fund, it means you don't need your current liabilities to cover it. And if you don't need your current liabilities to cover this liability, then it doesn't need to be in the current liability section. Right? So if you don't need your current assets to cover the liability, you use your long-term assets to cover the liability, then you would consider the bond a long-term liability. Okay, it is a liability, so neither isn't right, but it doesn't go into the current section because you're not going to use current assets in order to pay it off. Okay, yeah, you're going to pay it off within a year, but you're using this sinking fund, which is a long-term asset, and it's fully funded. Okay, now you can rewrite your info. Okay, so let's go ahead and do the, just talk quickly about owner's equity. One thing that you didn't see in Apple is a separate line item for treasury stock. Treasury stock is stock that the company has repurchased from the market. Why would it do that? Well, sometimes it's another way of basically paying back its owner. So instead of paying everybody a dividend, I can just cash out some select owners. Why else might I want to buy back shares of my company? Well, maybe I don't like the fact that you all own my company and I'd like to have more control. So I might be able to buy back shares for that reason, for control. And then another reason is I plan on using the stock to compensate my managers. Well, I need some stock on hand in order to do that. So I buy back the shares and then I distribute them to my executives. Common stock, we already talked about. It's either just one line item or common stock and additional paid-in capital. Together, those two represent the contributed capital, and retained earnings is the amount that was reinvested in the firm after being earned. Okay? Other comprehensive income is that other stuff. Okay, so now let's do this problem just like we did last class. But now we're just going to focus on the liability and equity section because we've already done the asset side. Okay, so remind me which of these items I want to include. So accounts payable, what kind of account is that? Current liability. Okay, so we're going to use that. Accounts receivable. All right, so we're not interested. Accumulated depreciation. Contra assets, so not interested. Cash, not interested. Okay, common stock. Owner's equity. Okay. Equipment. Interest payable. Okay. Inventory. Note payable due in 10 equal installments. Okay, so 10 equal annual installments. So we're going to put 10,000 in current and 90,000 non-current liabilities. Okay, patent, prepaid insurance, retained earnings. All right, so we've got 1, 2, 3, 4, 5 things to deal with. Let's make sure our balance sheet's going to balance. Okay, so we have current. So you're going to start with liabilities and shareholders' equity. Now, I don't need the title and the account and the information because I already have it in the first half of my problem, right? I'm not going to write it all over again. But, you know, in a normal balance sheet, you would want to have the title, the balance sheet, the date, and so on. Okay, so what are my current liabilities? Accounts payable, and what else? Interest payable. Anything else? Current portion of notes payable. Okay, so how much are all of these things? My accounts payable are 12, my interest payable is 2, and my current portion was 10. Okay, so total current liabilities. Okay, and then we have my non-current liabilities. What do I have? Okay, anything else? Nope. Okay. Now, I cannot tell you why, but typically companies do not total their liabilities. They just do a total for current, they list their liabilities, and then they go to the equity section. Okay? I don't have a problem with you having a line item that says total liabilities. That's fine. You just won't see it for some reason on lots of companies. Okay, so then we're going to equity. We have common stock. Did we have common stock? We better have common stock. Okay, and retained earnings. So what's our common stock? It's 70. Retained earnings is 76. Okay, and they do total up total shareholders equity, 146. And then we have a final total liabilities and shareholders equity, and that is 146 plus 24, 170 plus 90. Didn't we have 260 last time? I hope. Didn't we had 260, right? So that's it. Okay, good. Phew. It's a pain if you screw up somewhere. Okay, so any questions at all about how to create a balance sheet? If I asked you to do this on an exam, could you? Like this would be fair game. I could say, here are a bunch of accounts, create a balance sheet. So be prepared. Okay. Let's talk a little bit. We'll do one more big problem, okay, to really get our bearings, okay? Here are a bunch of, so let's say we have a new accountant, and our new accountant is not that good at accounting. So they didn't get an A in this class, they got kind of like C minus. And so they created this balance sheet, and then in come you guys to audit this information, and you're like, yeah, that doesn't look so good. Okay, so you decide you need to make some improvements to the existing balance sheet. So here's what you have, okay? You have a list of the assets, okay, or at least what this person claims are the assets, and then a list of their equities. And in this case, the word equity actually is more broad. It means liabilities and owner's equity. Okay, so here's what they have, and let's just start working through what's really wrong here. Okay, so number one, they have goodwill. Okay, now under what circumstances can a company record goodwill? When they buy another company. Okay, so we got to make sure that they actually bought another company. More importantly, what kind of asset is goodwill? Intangible. And like, where does it belong if I was going to put it somewhere? Like absolute last, dead last, okay, not first. So let's look at note 2, which just to make sure that they've done it right. So note 2 says goodwill in the amount of $120,000 was recognized because the company believed that book value was not an accurate representation of their fair value. So they were thinking to themselves, here's what we have on our books, and we are so much better than this. We deserve to have a higher book value. So we're going to actually record an extra $120,000 so our investors know we are good. We have this goodwill. And they didn't really know what to do with it, so what they did was they included this increase in goodwill directly in retained earnings. So the hypothetical journal entry that they made looked like this: goodwill 120, retained earnings 120, or possibly gain 120, but they did this last year, so it's already in retained earnings. So what do you think? Is that goodwill legit? Okay, so what should the goodwill be? All right, so we want this to be gone, 0. Now, if we take $120,000 off of this total here, what's going to happen? Our balance sheet won't balance anymore. So what else do we have to do at the same time? Take it out of retained earnings because it's there too. Okay, so let's subtract. So now we have 738 in retained earnings. So even though our number is still may be wrong, at least we have a balance sheet that balances. Okay, we're going to work on it. The second thing, we have buildings. Okay, how should buildings be valued? Historical cost minus any depreciation. Okay, let's kind of check out and see what has happened. Buildings are stated at cost except for one. That was recorded at the appraised value, and the excess of the appraisal over the cost was $570,000. So what are they telling you? So this number is 570 too high. Okay, what did they do with that? Well, they just stuck it in this account. So how did they get from the original historical cost to this new number? What they had done was they basically wrote buildings 570 and appreciation capital. So what do we want to do about that? Get rid of it. So we need 1070 here. So we're just going to change this value and completely chuck this line. Where does buildings go? Like, where would the account buildings go? PP&E. Now, what are we already, so this is part of PP&E. We talked that we need some depreciation, and they said they have been depreciating their assets on the cost basis. So where's the depreciation? It should be part of PP&E as a contra asset. Is it there? Is it? Well, then we get to inventories, land, receivables, treasury stock, cash, assets, plants expansions. Maybe they went net. Maybe. Keep reading. Reserve for depreciation recorded to date on building. Is this in the right spot? No. So what are we doing here? We need to take this here, okay, and move it up here. But what happens when we move it up here? We're going to get a little bit screwed up, right? Because we're subtracting 410 here, and then we would be adding 410 here. So how do we move it? Yeah. Okay, so if we had done depreciation incorrectly, we would have to make that kind of adjustment. Yeah. Okay, so we're going to move it, but we're going to move it as a negative number, right? So accumulated depreciation is a contra asset. So we're going to have accumulated depreciation, and it's going to be minus 480. Okay, whoops, or 410. Okay, so it's going to be, we're taking 410 off of this, and we're taking 410 off of this. Okay, that's the way it's going to work. It's that it's been recorded as an equity, but it really should be a contra asset. If not an asset, if it were an asset, it would be increasing the assets, but it's actually decreasing the assets, and also we're taking it off of here. Okay. Now, what about inventories? Where do they go? Okay, land. Okay, accounts receivable. Treasury stock. Okay, treasury stock is stock that we own, or stock that we bought back in our own company. Now, one of the primary rules of accounting is that you can never show a profit on sale of your own stock. Okay? So even though if I own stock in another company, I consider that an asset. If I buy stock in my own company, it's not an asset. It's just a reduction in the ownership, right? So I can't own myself. If I use cash and I buy shares of my own stock, what I'm doing is I'm basically taking some of the owners and saying, you guys aren't owners anymore. So my own stock, which is what treasury stock is, can never be an asset. Where does it belong? Owner's equity. What kind of owner's equity account is it? It's a contra owner's equity account. So in the same way we just moved this, whoops, here, move that. Move this at 87, we're going to move treasury stock minus 87. So think about it this way. We have a bunch of shareholders that give us their money. And then we say, you know what? We don't need all of you. Here's a little bit of money, here's your money back, and we'll take the share back from you. It's as if that kind of transaction never happened. So if in our common stock we have all of the shares we originally sold, treasury stock is then saying, oh, but here's what we gave you back, okay, and took back from you. Now, cash on hand. What kind of account is that? Cash, current asset, very liquid. Okay, number one. Let's put that as number one. Now, assets allocated to the trustee for plant expansion. So there's some cash and some treasury notes. So these are assets that we have earmarked and told our trustee to use for plant expansion. That means we can't use them. We've put them in a trust and we can't touch them. So what kind of assets are those? Probably long-term. They're definitely not. This can't count as cash because it's restricted. So at the very least, we'd have to call it restricted cash. Okay? To the extent that the plant expansion is going to take more than 1 year, this might be a non-current asset. Okay, then let's look at the next thing. Notes payable. So there's a note. We got to read what the note says. Notes payable are long-term except for the current installment due of 100. So what should I do with this? 100 is going to be current liability. 500 non-current. Common stock. Where does that go? Owner's equity. Retained earnings. Owner's equity. Taxes payable. Current liability. And then treasury stock is contra owner's equity. And accumulated depreciation was contra PP&E. Okay, so I'm going to give you, now we've discussed and decided where everything goes. Take 5 minutes and create a decent looking balance sheet. And then we'll talk about what goes where and why. So let's look at what we need to do to start out. How do I start out making a decent looking balance sheet? Okay, so let's start super basic. We don't know the company name, let's just call it company name. Okay, statement of financial position, you'll sometimes see, or just balance sheet, that's fine too. Not both, but one of these. Okay, and then the date, 12/31 XX, whatever date we're on. Okay, some date. So the balance sheet is telling you, we're not telling you what we look like on anything but this particular date. On this particular date, here's what we had, and here's what it was worth. Now, not what it was worth in the market, what it was worth as measured by accounting principles. Okay, so then what do I do? Okay, start with assets. Then what do I do? Okay, now, I am pretty tolerant of all sorts of crazy formatting, and I'm not looking for a beautiful presentation. But if you have the time and the luxury, you want to try and make it legible if possible. Okay, for your own sake. Okay, so current assets. What are our current assets? Why is cash first? Most liquid. Okay, then what is the amount of cash? Then what? Accounts receivable. Okay. Typically, how often are accounts receivable, or what is the length of time in which you can expect an accounts receivable to be paid off? 30 days usually. Okay. How much is my accounts receivable? 170. Okay. Then what? Inventories. Why are my inventories less liquid than my receivables? People have to pay me cash both for the receivables and the inventory. So why is inventory farther away from cash than receivables? Okay, so first I have to sell the product, then I have to collect the cash. Whereas with the receivable, the product's already sold. Okay? What's the amount in my inventory? 312, 100. Any other current assets? Okay, so total current assets. Okay. Yes? Okay, so the current portion of long-term liabilities is current, but is it a current asset or current liability? Okay, so we'll get to it. We haven't gotten there yet. Okay, then what do? I have my non-current assets. Okay, so what are they? So I have PP&E. What's in my PP&E? Land, building, less accumulated depreciation. Okay, so how much land do I have? 953? Oh, just 950. Okay, building. Okay. And what's my accumulated depreciation? Oh, whoops. Okay. So what is my total PP&E? Okay. Everyone agrees so far? Anyone uncomfortable with any of these numbers? Why they're here, where they belong? Okay, what are some of our other non-current assets? So I'm sorry, I just, okay, so the trustee held assets, which include cash in the bank plus something else, I forgot what, plus U.S. Treasury notes, okay? So let's just call those plant expansion assets, okay? So we had cash and Treasury notes. The cash was 70 and the Treasury notes were 138. Okay. Okay, anything else? Okay, so now total assets. 2476. Okay. Does anyone have a different number and they want to discuss why? Did everybody come up with 2,476,000 in their asset section? Yes? Okay, so we can all, we're all good. All right, now how about our liability and owner's equity section? Okay, so liabilities and stockholders' equity. Could be stock owner's equity, stockholders' equity, shareholders' equity, that doesn't matter. Okay, what do I start with? Liabilities, okay, and then we'll do the current ones. So what are my current liabilities? So taxes payable, current portion of notes, anything else? Okay. So what is my taxes payable? And my current portion of the note. So total current liabilities. What are my long-term liabilities? Okay, so the rest of the notes payable. 500. Anything else? Okay, now how about shareholders' equity? Okay, we have common stock. What else? Retained earnings. And treasury stock. Okay, so what's in my common stock account? 115. Okay, retained earnings? 738. And treasury stock? Okay. So, is that it? Have we got everything? All right, so what do we have as our total liabilities plus owner's equity? 175 plus 500 plus 1,150,000 plus 738 minus 87. I sincerely hope we have 2,476,000. Do we? Okay. Could I could certainly ask you a question like this on an exam. Could you do it? Am I putting it exactly? Well, why would I have to put it exactly like that? I can. Okay, so what parts of this problem, if anything, were hard or confusing and that you want to discuss? Okay, well, so that's a bad attitude to have. During the exam, I can do this just as well as I can do it right here. Okay, and plus you'll have studied for it. Yeah. Okay. Okay. Sure. So let's talk about a couple of things that you might not have gotten right. Okay. You might have thought, hey, this says cash in the bank. Just because it's allocated So what would the penalty have been for sticking it in the wrong place? I don't know, half a point. Like nothing major. Like I'm not going to kill you for things that are hard and that you might not know. Okay? What would I be more? I would expect, it's true, I don't expect you to know certain aspects, or like if there was other comprehensive income, you might not know what to do with it. However, you need to know that depreciation or accumulated depreciation, just because it has a credit balance doesn't mean it's on the liability and equity side. That absolutely needs to be a contra asset. We need to know, how do you value the basic assets and basic obligations on your balance sheet? So is it something that, so if I just said, hey, I developed a patent internally, it cost me $50,000 this year to develop, and so I recorded it as patent, can I do that? No. So just because I've done it doesn't mean I can do it. So you need to kind of basically say, which assets can I record, and if I record them, what's the valuation principle that guides them, and then take it from there. So everything, the treasury stock, yeah, I realize that one's hard because we don't totally have a handle on what treasury stock is, and you probably won't get a good handle on it until like the end of intermediate 2 when you do the equity section. So, small little mistakes here and there on those kinds of things wouldn't be a big deal in my opinion. Okay? Treasury stock is always a reduction in owner's equity. Okay? Treasury stock always has a debit balance. Okay? It can either have it has a zero balance if you don't have any of it, or a debit balance. The debit balance reflects the fact that you've basically been buying back the shares. Okay? So it's a reduction in how much your owners originally contributed, because you're basically giving it back to them. Okay? So instead of the reason you do it here is you just want to leave this number alone. This is how much you originally issued. So in order to be able to leave this alone, when we buy back shares, we just hold it in a separate account. It's kind of like depreciation. We leave the asset alone at its historical cost, and we just reduce its value by depreciating it. Well, the same for common stock. We leave the original contribution alone, and then we just make changes, buybacks of those shares in a separate account called treasury stock. Okay, other things that you might have found tricky or didn't totally get.